We've all heard motivational speakers telling us that high risks will bring high returns. But guess what? It's a lie. Are you wondering about those 3 important words in investing by Warren Buffett? Or are you wondering how those billionaire investors have high returns with low risk? Before we move on, make sure you press the like and subscribe button so that you stay updated with everything related to financial independence and stock market investing. Welcome to 5-Star Finance, the place where you learn how to achieve financial freedom. Businesses are extremely important for value investors. It is the understanding of these stocks and companies that differentiates the successful value investors with the other ones. Every company has at least 3 pieces of paperwork that they have to look after and account for. And these 3 statements are income statement, balance sheet, and the cash flow statement. But it is the balance sheet that is used to determine the margin of safety. Now, the margin of safety is simply the safety net you will get if you were to purchase a business. So, let's dive in and understand these terms in a better way. What is a balance sheet? As a value investor, you need to get yourself a lot more familiar with the balance sheet. The best way to understand a balance sheet is to ask yourself this question: what would happen if the business dies right now? Or you turn the entire company into cash and you simply enter. What is it worth right now? It's not about 10 days ago or 10 days after. It's about what the business is worth at the exact moment the picture was taken. Now, in order to understand how much the business is worth, you need to carry out a simple procedure. Simply start by summing up all of the assets, liabilities, and get the equity. For example, if you're looking to go after an ice cream business, you need to add up all the assets and the liabilities to determine the total equity. In the case of the ice cream business, the assets can be the cash in account, the ice cream stand, ice cream machine, the supplies, and the total land. Now let's take a look at what can be the possible liabilities. The liabilities can be the salary owed to all the people employed, the land for the business, the ice cream stands, and the ice cream machine. Notice that we've listed some terms twice. That is because the business or the company owner did not entirely own the ice cream machine and the stand, since most of the money was borrowed from someone to start that business in the first place. So when we subtract the liabilities from the asset owned, we will get an actual amount. This will be the original equity of the business. This sheds a whole lot of light on the ice cream business. The balance sheet, in simpler terms, is the equity of a business. You also need to understand that the equity term holds only when you own the entire business. But when you have a share, the term equivalent to the equity is the book value. Book value is the equity of a business per share. Now, when the business owner wants to sell the business or simply wants to get rid of that ice cream business, the owner will obviously demand a price. It will be all good and sunny if the owner actually gets what is demanded. But in a scenario when the buyers are hard to come by and no one's willing to buy that business, then the business owner will get paid an amount equivalent to the equity. For example, if the ice cream business owner was demanding $150,000 and the equity is $10,000, but no one was actually willing to buy the business, then how much is it actually worth? Now, if the owner really wants to kill the business, it is going to have $10,000 left at the end of the day. The greater the difference between the equity and the price demanded, the greater is the risk. It is with the help of the balance sheet that the value investors can find the value of a company. Finding stocks that sell below their balance sheet's values are rare today, and there are other ways to determine margin of safety. What is the margin of safety and how can you utilize it for your benefit? So, this difference between the equity and the value of the business is termed as the margin of safety for a business, and this is an important term to understand for all the value investors. The margin of safety can also be related with the cash flow generated by the business as well as the balance sheet. No doubt that Warren Buffett says that the 3 most important words in investing are margin of safety. The difference between the intrinsic value of the business in consideration and the market price is termed as the margin of safety. So the question arises, why is it important to understand the margin of safety for value investors? Since the system on which we depend for quality education has failed to enrich us with these terms, it is highly dependent on how we choose to learn these important skills, especially for those interested in stock market investing. In mathematical terms, if a business has X assets in sales and Y assets in break-even sales, then the margin of safety will be X subtracted from Y. It should be noted that the break-even point is the point at which the total cost being expended on a business is equivalent to the total revenue being generated. To put the long story short, sometimes it is hard for businesses to sustain their market price, and as a result, their market price falls below the actual value. This was where most of the value investors hit the jackpot. By using the margin of safety, many value investors are able to buy stocks at reasonable prices. This is why the great Warren Buffett also preferred to focus on small businesses with little coverage when he was just starting out, so he could seize more of the price to value discrepancy, or in other words, a higher margin of safety. Investors often choose to vary their margin of safety in accordance with the amount of risk involved. This helps them against the downfall, since they're already playing productively by clinching the business below its actual value. With a low margin of safety, it is often understood for value investors that the business won't yield high profits, and safe to say that they might want to reconsider. But with a high margin of safety, the chances for their profits can significantly improve. No doubt a high margin of safety is where most of the value investors find their happy places. If you're new to investing and are looking for a start point, make sure you refer to the ebook given in the description below. This free ebook explains the 6 different stock categories which are important for every value investor to analyze. We believe that building a passive income stock portfolio is the best way to achieve financial freedom, and the best place to start is by learning these 6 different stock categories. What do you think about the balance sheet? You may proceed by calculating the margin of safety for the businesses you're planning to target by using the balance sheet. Let us know about your future endeavors in the comments section below. Subscribe and turn on notifications so you never miss another video. Check out the video we handpicked for you, and we'll see you in the next one.